Hi, this is Daniel. You're watching Unrivaled Investing. In this video, I wanted to break down how do you value Berkshire Hathaway stock and why do so many investors believe it still has such a promising future? If you enjoy educational investment videos, please make a point of hitting that subscribe button. So since Warren Buffett took control of Berkshire Hathaway, the stock has performed nearly 3.8 million% return. 2022 was another year of outperformance. S&P declined around 18%. Berkshire Hathaway delivered positive 4% of performance. A lot of hedge funds wish they could have delivered, 3.8 million% since 1965. Why did they generate this outperformance in 2022? Well, their results were actually decidedly mixed. While their core earnings were up nicely from $27 billion to $31 billion, their investment portfolio declined over $50 billion. So this is going to be a lot of volatility, partly because Berkshire Hathaway has such a large stock portfolio that goes with their sizable insurance operation. So if you have a $300, $400 billion stock portfolio and the broader market declines, that's going to hurt their results when they report their earnings, because that volatility now gets lumped in with their results. And so that's the reason why their equity value, or the core value of Berkshire, declined by $23 billion last year. However, Wall Street sort of gave them a pass because their core operating earnings continue to expand. So Wall Street's saying, hey, there's going to be volatility in your investment portfolio, but as long as your core operations are doing well, that's what gets us interested. And that's the reason why I'd argue the stock performed better than the S&P 500. So then you look at, who owns Berkshire Hathaway, and it's an amazing list because the reality is it's dozens upon dozens, hundreds of funds continue to buy into and own Berkshire Hathaway. Some of them own it for the long haul, but some of them, are recent buyers. And you can look at, it's buyers and sellers of all sides that are into this. You have University of Notre Dame that has over $100 million investment. And then you have a bunch of smaller shops that own, 20% plus of their investment portfolio. So this raises the question, well, why do they even own it? If you're a small hedge fund or, asset manager, why do you put 30% into Berkshire Hathaway? And I think what it comes down to is they believe that you're looking at a business that can still, let's say, perform in line or better than the S&P 500 over time. And it doesn't have a lot of the risk that you have with a lot of other investments out there. You're having sort of a sanctuary, a business with 100 billion plus in cash, lots of free cash flow, one of the best capital allocators out there, Warren Buffett. He is getting old, but he's hiring, top talent to continue managing the portfolio in the years ahead. So even if, and this is a super important point for viewers to consider, because a lot of folks are looking for, myself included, looking for that next 10 bagger, that type of stock can go up, 1,000% or even more over time. A lot of investors say, hey, I'm comfortable getting an S&P maybe plus a little bit return over time. And I'd like to just do that in a stable way. And maybe this is better than holding cash. And that's what some investors do. I personally would rather have the cash. And then when I see something that's really high conviction that I think can compound at 10 to 20%, over time plus, that's when I go, okay, that's when I want to make an outsized allocation. But for a lot of these other investors, I think this is an example of career risk. They don't want to get fired. And they think that over time, they're still going to be getting, with Berkshire Hathaway, a high single digit, maybe a low teens return. That's how they're thinking about it, and why it's still a large percentage of the portfolio for literally hundreds of different investment managers out there. So how do you think about valuing Berkshire stock? I do have a valuation course to think about valuing stocks in general. It's what I would have wanted to know when I first started on Wall Street, sort of giving the basics. Also, a course on how to read financial statements. I also have Unrivaled Investing, which shares the things I'm buying and selling for the subscribers. But thinking about how to value Berkshire Hathaway, the reality is it's a business that owns so many various different segments. I mean, you have dozens of different business lines across really the world in terms of what they sell, heavily levered to the US economy. I personally look at this, and this is how I've sort of simplified the data, and this is what they largely provide. But you have insurance operations, which are significantly profitable. So they're providing insurance to businesses, individuals around the world, whether or not it's car insurance or property and casualty insurance or reinsurance. What they're doing is saying, hey, if you have some sort of risk, we can help you protect against it. And generally, the insurance policies that they write are profitable for them in aggregate. They will have money losers. Last year was a sizable loss for their Geico auto insurance, nearly a $2 billion loss. But in aggregate, over a multi-year perspective, they're underwriting, the insurance policies they write are profitable for them. Plus the money that they get while they hold the premiums, that's called a float, that is increasing in value, partly because interest rates are moving up. So you saw the float investment income jump up significantly. I suspect it'll be even higher this next year with interest rates where they are. And then you have this cross section of businesses around the United States, around the world. You have energy, you have railways, you have manufacturing. Manufacturing saw a sizable uptick, partly because of their Clayton Homes prefab home division that saw this huge surge. Maybe people are finding it easier, more affordable to buy, prefabricated homes versus, buying, on the used or new market. So and services and retailing, which once again includes dozens of different businesses. So when you add this all together, you're sort of looking at a business that is generating around $30-40 billion in pre-tax profits. And this is, once again, spread across dozens of business lines. You can see the largest players like the Geicos and their insurance lines and their investment income and their manufacturing, but it's really spread across a lot of different things. Some of the largest is Geico, their reinsurance, Burlington Northern Santa Fe, one of the largest railroads in the U.S., their energy division, which is much smaller than the railway, but you can see wow, this is just dozens of businesses, around 30-40 billion in pre-tax profits. So then the next component, so when you're thinking about the valuation of Berkshire, you're going to say, okay, so there's all these earnings components. And then, well, with your insurance investments, not only do you have this float from these premiums that you collect, but you can invest in. You're required to keep a lot of it in safe things like treasuries and bonds. But when you have a lot of excess float that builds up over time, you can reinvest it how you see fit in riskier assets like stocks. And they have just a tremendous stock portfolio that's, around, give or take, depending on the year, let's say $330 to, let's say, $375 billion. So just a huge portfolio. So when you're thinking about valuing Berkshire, you want to take their core earnings, which is around $30-40 billion, and then add what you think they could do with their investment portfolio over time. Now, you might say, well, wait a second, that investment portfolio doesn't actually belong to them. There's this, offsetting liability from all these insurance claims. But as long as they continue to write profitable insurance, or at least break even, then they actually benefit from that stock portfolio that they own that's, generated from the float from their insurance operations. So the way to think about it is you have this earnings power plus the long-term compounding potential from a $300 billion plus stock portfolio. That's at least how I sort of break down what's the earnings power, the normalized earnings power for Berkshire Hathaway. So what happens when you put these pieces together? First, in full disclosure, this is not financial advice. And if you're interested in following my personal journey, I call it out at unrivaledinvesting.com, for compelling ideas. So thinking about Berkshire Hathaway from here, this is a hypothetical valuation framework. Stock price go way higher, way lower, but this is, let's ground it in some realistic, what I believe are realistic assumptions for what can happen to Berkshire Hathaway stock from here. So the first is, what's sort of that normalized earnings? Normalized earnings after tax, maybe around $45 to $50 billion. That assumes you're getting maybe a high single digit after tax return on a $300 billion plus portfolio, plus that $30 billion plus in earnings from all these different, dozens and dozens of different operations. So when you are 30 to 40 billion from that, pre-tax from those, dozens and dozens of operations. So you look at that on an after tax basis, I think the normalized earnings for Berkshire is probably around $45 to $50 billion of what it could be right now. And keep in mind, this is for a business that's currently around, nearly $700 billion valuation. So by no means would you say this is, really expensive. This is below market multiple. And this is part of the reason why I think a lot of investors also own it, is not only do you have the stability and the sort of the pride of owning along with Warren Buffett, but you also can say to yourself, with a reasonable framework, sort of say, hey, S&P 500 trades at around 20 times. This is closer to 15 times on normalized earnings basis. So this seems much more, a much greater discount than what you can get with the broader market. And then the question is, okay, so what do their operations grow at in the years ahead? If you look back at how they've done, let's say, the past decade, their growth rate, their core growth rate with the businesses that they own, it's, mid to low single digits, around 4, 5, 6%. So not crazy compelling, but that does get factored into how to think about this valuation. So if you currently have 45 to 50 billion, what's that growth rate in the years ahead, including how does their portfolio compound? So I'm assuming somewhere between 4 and 6%. You might say, Daniel, you're being conservative here, but there are real, sort of existential risks over time. If self-driving becomes a huge part, maybe that means, fewer Geico insurance business in the future, and maybe that business declines. Or Burlington Northern, if you have electric trucks, could that disrupt the rail industry over time. So there are some risks over time that could make it, grow slower. I look at Berkshire's portfolio and I think they've handpicked some of the best businesses they can own with pricing power. I look at it as GDP maybe times 2 type business. So if GDP is growing at maybe 2%, maybe they're growing closer to 4, maybe 5% over time for their core organic business, looking at their various different business lines. And so thinking about, okay, so 45 to 50 billion in normalized earnings, growing somewhere between 4 and 6% over time over the next 5 years to, maybe 55 billion to 60, 7 billion in earnings power, in which case you're really trading at, 5 years out, maybe you're trading at really low teens earnings multiple. So then assuming maybe 5 years out, Wall Street gives it a multiple somewhere between 14 and 18 times. Part of it's, in the range of where it currently trades. Sometimes it's at a premium. We'll see where it goes from here. Plus, the fact is they still do generate meaningful amounts of free cash flow, even if they're not finding compelling acquisitions or they're not buying stock. I think in fourth quarter, they were actually, Warren a big buyer. I think they might have even been a net seller of stocks. You look at this business generating 20, 30 billion in free cash flow. So not even factoring in their stock portfolio appreciating, but the fact that they have this 20, 30 billion in free cash flow that Buffett and his lieutenants, will be able to allocate, that's cash that can go back to you as a shareholder. They're not currently doing a dividend, but that does mean buybacks. And you have seen that the last few years based on the current stock price, 30, 40 billion dollars that can get returned. That's equivalent of a 3 to 4% yield in terms of buybacks each year. So between this growth of, let's say, 4 to 6%, plus the ability to do buybacks of around 3 to 4%, maybe 5%, you're automatically talking about high single digit potential returns. If you do a little bit of valuation expansion, now you're talking about potentially even higher. So I think a lot of investors, and this is part of the reason why hundreds of different investors out there own Berkshire stock, is because they look at something where they say, hey, I can conservatively pencil out something that's in line with, let's say, the S&P 500 over a multi-decade perspective, and maybe it does more than double what the S&P 500 does over a multi-year perspective, because historically S&P does around 6-7%. So maybe it's in line with the S&P 500, maybe it's double it. And this is, I think, part of the reason why a lot of investment managers say, hey, I can own this instead of cash, still collect my management fees, and I can potentially do better than I can do better than the index potentially with Berkshire Hathaway stock. So I think that's the appeal. I personally look at it and I say, I instead of thinking of a business as a cash substitute, I'd rather just wait for things that I can comfortably say, okay, in my low case scenario, I'm getting like a 10%, and maybe my high case, I'm getting closer to 30%. But look, every investor has their own different preferences. I can understand why some of the super duper wealthy, and I've talked to some super high net wealth individuals, that own Berkshire Hathaway stock. The reason why they do it is just sort of the comfort and satisfaction in how they sleep at night. They go, okay, I'm comfortable compounding, even if it's not a super high growth compounder from here, even though it's, gone up like 3 million, percent since Warren Buffett took over, it's still in a position where I still think it'll compound at reasonable growth rates in the years ahead. If this video talking about how to value Berkshire Hathaway has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.